Good morning. We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
And our top story is the Fed keeps rates on hold as inflation cools, but dials back easing forecasts, penciling in just one reduction this year and 4 in 2025.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
Traders, though, are largely shrugging off the Fed outlook with swaps contracts still pricing for 2 rate cuts this year. And, of course, we move into the BOJ and the policy meeting also getting underway today.
Plus, China's Commerce Ministry slamming the EU's move to slap extra tariffs on its electric vehicles, accusing Brussels of ignoring the facts. All right, a quick look at the market action this morning, how we're trading so far in the session. You got a lot of positivity really coming through in equities in particular. Now, not too much of a surprise really. We saw the S&P 500 pushing above that 5,400 mark. We saw Treasury yields coming off in the session. We saw the dollar also a little bit weaker. These are supportive factors for stocks. This is all, of course, the market reaction we're getting today to the FOMC decision. Ahead of that, we saw those inflation figures coming in, and we saw that deceleration over that month as well in the latest reading. So Jay Powell, his colleagues, now penciling in just one cut for 2025 or 2024, rather, pushing the can down the road of sorts into the next year in turn. Of course, as we said, that market reaction, very supportive for equities. But of course, in this part of the world as well, we're watching a few different stories today. Let's change on, take a look at the EV names in particular, because here we saw a slide in the prior session. This is the last close for ones that are listed in the US. And that's also a day 2 reaction as well, because we actually saw them selling off in anticipation of those curbs being put in place, or the EV essentially, EU rather, hiking extra duties on Chinese-made EVs to nearly 48% or 48% from some models. How that's going to really play into the session today, that's the question as well. Let's take a look at how futures are faring so far. And what we're setting up for today is a fairly steady trading somewhat. That's what we've got, Dave, of course, half an hour out now from the open for mainland equities.
Yeah, so I think you've lined up really very nicely the different pockets of this equity market to watch. The EVs, for example, and as Belle is pointing out, we already did see quite a stark approach into those tariff announcements in the Asian session yesterday. BYD, of course, watched it closely. What perhaps within this space, it's SAIC, which we're tracking most closely, following that the company did get the sort of the bulk of the increase there. Right, a couple of other things to watch. Property stocks. So obviously what the Fed does, we basically take here at Hong Kong. The property gauge, the Hong Kong property gauge, to be more specific, has been on a downtrend yet again. In fact, the lows that we hit a few months ago are now very much in sight. We are in the window still for May credit numbers coming through. And as far as earnings go, it's Chow Tai Fook should be reporting at the end of today's session, if not midday. That comes out today, suffice to say. One-year yield in China, 1.6%. Dollar China, 7.26 on your screens right now. It's a dollar story, and let's see, of course, and more on the Fed story, of course, Belle.
Yeah, as we were discussing, the officials penciling in just one interest rate cut this year and forecasting more for 2025. We heard from Chair Jerome Powell saying inflation is easing but remains too high.
We see today's report as progress and as, building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having, the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
Joining us today here on set is Neeraj, Seth, CIO, head of APAC, fundamental and fixed income at BlackRock. Good morning. It's nice to see you in the region, by the way.
Thank you.
It's as if the Fed didn't have a meeting. I'm not sure how much better off we are in terms of information. Certainly the CPI print from overnight also a few hours before that did take most of the price action. Just your thoughts on the event, non-event?
So somewhat of a non-event, because going into the FOMC, the bid-ask was 1 cut, 2 cut, expectations for 2024. So we landed on 1 dot for 1 potential cut for 2024. And I would say if you listen to Chair Powell, the overall message was a bit more balanced than outright dovish compared to the previous press conferences. But all in all, not a huge lot has changed. I think the CPI print was important. Mm-hmm. There's clearly disinflation in play, but given the data has been somewhat, the non-linear equation of the disinflation, it really, one data point doesn't make a trend, and hence the Fed is still reasonably cautious on calling the point at which they get to 2%. And the only point I would note which was relevant was they did increase their expectation for core PC for this year and next year. Yeah. So they certainly are looking at potentially more persistent inflation in the system.
And then, of course, that goes against what the markets are expecting as well, because the market is still pricing in more cuts than what the Fed is thinking for this year.
I think markets, in some ways, as long as the Fed stays that it's okay, higher for longer, but eventually the path is slower but lower. The markets will keep testing that. Slower is how slow is that? And if Fed says 1, the markets will try to go again back towards 2, with obviously the possibility of 2 is now much lower. The probability of rate cut in September is less than 50%. And I think we will go back and forth between that pricing now.
Right. And your other point earlier on was, the fact that it's higher for longer, say the low in the next cycle on the Fed funds rate will be higher than the last cycle.
Absolutely.
Higher neutral.
Absolutely.
Well, what does it mean for returns then in that case?
I think to some extent what we've seen over the course of last 18 months is the U.S. economy has been very resilient. And you look at the returns, they have been actually good. Now, what it means is the idea of free money flowing through the system, which actually was in some ways always a risk of creating bubbles. Right. I think that's lower. The cost of capital is not going back to zero. I don't think the Fed has potential to go back to zero. And if anything, if I take a step back and think about it in terms of the different variables of how you look at the policy, you do have obviously the Fed fund rate, but you also have the Fed balance sheet, which is much larger. Yeah. And you have the fiscal dynamics outside of the Fed control, which are very different. We're in much higher fiscal dominance situation for the expansionary fiscal policy alongside a larger balance sheet. So the base case of Fed going to zero, I would say, is very, very low probability in the next cycle.
So then how does that really set the stage then for central banks in Asia, because they've been so constrained by the Fed's moves?
I think central banks have to be on same patient path. I don't anticipate in case of Asia any of the central banks to actually front run the Fed. I would say, in fact, most of the central banks have shown their cards, including, if you remember, a few months back when Bank Indonesia raised rates when the market was expecting a cut.
That was a currency story.
That was a currency story. And I think a lot of it comes back to the macroeconomic stability, currency, and the inflation implications of that weakening currency. And hence, I don't think the central banks in Asia will rush towards cutting. But in some ways, it gives investors a window to actually benefit from the higher rates in Asia. The nominals are high. And if you look at the inflation data in larger economies like India, China, Indonesia, it's all pretty benign. So you're getting more positive real rates in Asia, which actually was not the story in the last cycle.
So what does it mean then for just investment strategy, fixed income and everything else for the second half?
So I would say the key for fixed income still very much remains a diversified global investment strategy. You do want to obviously take more carry in US. Okay. The one point which obviously will keep coming back over next 6, 12, 18 months in case of US is the fiscal expansion and the fiscal financing requirements, which can have pressure on the curve. But when you think about rest of the world, specifically in Asia, here you can take a lot more duration as you go towards the end of the year and next year with the expectation of rate cuts. And potentially over time, the currency actually should also play in your favor. So all in all, I do think Asia gives you a diversification with high nominal and real rates and potential for capital appreciation as we go into the end of this year and next year.
Do you want to be generic, though, or are you being a little bit more selective how you go about it?
No, you would be more selective. I think I must say, again, looking through the world, we have not seen this level of lack of synchronization in global economic and monetary policy cycle. Right? You have central banks. Still, we're waiting for a hike from BOJ.
Yeah.
We're expecting some cut in China. We're seeing cuts in, obviously, you saw in Canada and Europe. So I think that there's lack of synchronization, but what that provides you is a really interesting backdrop to have a portfolio that gives you the benefit of duration where you expect the rate cuts to actually come sooner. So in case of Asia, we like India, we like Indonesia, we like the fixed income in China. And then I would say selectively, Korea still looks interesting, but you'll have to keep an eye on the currency front. So I think you have pockets where you can take unhedged versus where you take unhedged exposure on duration.
What about Asia high yield? Because, spreads have compressed substantially.
I think there's still more to go. Because if you look through the absolute level of spreads in Asia high yield, and then you look at it from a relative perspective compared to the US or European high yield, I think you still have room to actually compress further. And when I say Asia high yield, I would actually take out a lot of the distressed names in China real estate, because that distorts the picture even
That's
more.
right.
But broadly, you still have room to run there.
All right, China property, that's actually a good note to end on, because we're going to get back to that in the next one. So we'll have more with Neeraj, Seth, CIO and head of APAC Fundamental Fixed Income at BlackRock in just ahead. And we're going to also be hearing from Societe Generale, because they've actually turned overweight on Chinese equities for the first time since 2022. So the head of Asia Equity Strategy, Frank Benzimra, will be explaining exactly why they're going with that call later this hour, because they're a little bit against the grain in some respects there, Dave.
Yeah, I'm also curious what Frank might think about EVs right now, given where price is, price earnings, and obviously all the tariffs overnight. In fact, on that story, and ahead of Frank, that we'll be talking about these new tariffs in Europe and what that means for the industry. And the open is what time is it now? So 18 minutes away, give or take. The opening bell. Futures should be pointing slightly higher. Last we checked. There we go. 1/10 of 1%. This is the China Show. Right, 15 minutes away from the opening bell, and futures are ever so slightly flat. Still brighter than mine, though. Let's talk about these EV tariffs and the new rates we're looking at here. So Beijing has blasted the move out of the EU to slap these extra tariffs on Chinese EVs, raising levies to as high as 48%. That's from next month. Now, the Commerce Ministry says the EU is ignoring the facts and the rules of the WTO. Min Min Lo, our China correspondent, is here with us to talk us through, of course, get us started, because we've heard the response already from Beijing as well.
Yeah, the Beijing Foreign Ministry have responded. Actually, why don't we just listen to it straight away?
Oh.
The anti-subsidy investigation is typical protectionism. The EU levying additional tariffs on EVs imported from China violates market economy principles and international trade rules, disrupts China-EU economic and trade cooperation, global automobile supply chains, and will eventually undermine its own interests.
So we know Beijing has previously hinted that they could impose a 25% tariffs on vehicles with large engines that are coming into China. That could affect brands like BMW, Volkswagen as well. I mean, these are car companies that have been most outspoken in criticizing the EU tariffs. The German Chancellor has come out to criticize it, saying that Europe should not close off its markets because they don't want the same treatment for European car makers overseas. And Beijing has previously also hinted that they could retaliate in tit-for-tat levies on things like European dairy, agricultural products, aviation products. So Airbus could possibly be in the crosshairs as well, because we know they were recently negotiating a huge deal with the Chinese airliners. So that's something we want to watch out for as well.
It's really interesting the way the EU approached this investigation, because the way that they've based the tariffs seems to also be on the level of cooperation as well.
Yep, so SAIC is the hardest hit. If we have that table, we can show that now. It's there will be 38% tariffs on SAIC. That is on top of the existing 10%. And the reason is that they are the least cooperative with the investigation. But the other reason also, we know the EC President Ursula von der Leyen has previously said that they will be tailoring the way they calculate the tariffs to correspond with the level of damage. And we know SAIC owns the British origin engine brand MG that's very popular in Europe. They sold over 200,000 cars in Europe last year. BYD trails far behind, just selling 16,000 cars last year. And that perhaps speaks to the resistance from consumers still towards buying these very distinctly Chinese branded cars.
There's also been some resistance from Tesla. What do we know?
Yeah, so Tesla is resisting because these tariffs, they are not just imposed on the 3 EV makers that were investigated. Other EV makers will also face tariffs that is a weighted average of those 3, so that's 21%. And if they do not cooperate with the investigation, then they will face the highest level of tariff, which is 38%. So nearly half of those EVs that are going into Europe are coming from foreign brands like Tesla, Renault, BMW. And so Tesla is pushing back. They are the leading player when it comes to exports of EVs. They're asking European officials to conduct an individual review of tariffs on Tesla, saying that they do not benefit as much from these state tariffs compared to the Chinese makers.
All right, that was Min Min Lo there, our China correspondent. And still with us is Neeraj Seth, he's CIO and head of APAC Fundamental Fixed Income at BlackRock. And Neeraj, curious for your views on this, because EVs is just one part of the story here. Overcapacity extends to other sectors in China. So do you think we actually reach a point where you see these duties or these tariffs really showing up in the exports at all?
So first of all, the tariffs specific to the EVs were well flagged and very well expected. So it was more a question of the exact quantum of what we get here. But if you take a step back and think about where we are in this world, I think we're entering the next inning of the global trade tensions. And to your point, the overcapacity, it is in a lot of different sectors that has been built. So it's EVs, the batteries, the renewable power, the solar panels. So question is obviously how effective the tariffs will be in terms of protecting the domestic industries as well as to some extent reducing that exports. I'm a little less sure that you can use just the tariffs to have that much of an impact. But it certainly opens a new chapter.
Is this inflationary, is the question?
This is inflationary. It's as simple as that. Basically, in this case, what we are doing is we're increasing the price of goods, or in some cases, the materials which are required for decarbonization, for consumption, for the end user. So eventually, this has an inflationary impact, and I don't think that's going away.
Separate to what we're seeing here is also the measures that we've got around the property sector, and we're seeing the PBOC, for instance, just yesterday urging SOEs to further increase their property buying. Do you see that starting to affect the fundamental picture at all for China?
It certainly has, but it's actually very early. And the measures that we have seen specifically, if you look at the 300 billion, the line of credit for the property sector from PBOC, I think it's a little too small and a bit too late. I do think there'll be more required to actually put a floor under the property sector and see a rebound in the sector. But what it does is it reduces the downfall from here. We have seen obviously the primary market sales continue to decline over the last 2.5 years across the top 70 cities. We have seen the prices still on the weaker side. I think this, to some extent, starts to actually get the sector to bottom out, but it's too early to say we'll see a rebound. I still think the cycle has a little longer to go in terms of bottoming out and rebounding, which can easily take another 12 to 24 months.
And just very quickly on the CGB space, authorities have pushed back and said, bull market over effectively. Do you think yields, how does that dynamic work?
They've been saying that, but if you look at the price action, you've seen the front end going down by almost 50 basis points this year to the long end between 25 to 30. Structurally, if you look at, again, stepping back from a fundamental perspective, the inflationary impulse in China is missing. The CPI was 0.3% and PPI was well in negative at minus 1.4%. So the inflation remains extremely benign. The real rates are still very positive. So I don't see what really pushes the yields higher. There has been, again, well-flagged issuance coming through of special CGBs. But all in all, structurally, I think we can still see yields going lower from here.
Fantastic having you here on set. Neeraj Seth there, CIO, head of APAC, fundamental fixed income there at BlackRock. Right, going into the open, just under 10 minutes away. Futures should be coming off highs of the day last we checked there. Dollar China, bottom of your screens, reference rate, 7.1122. The open, 8 minutes away. This is the China Show.
Here are some of the big stories we're following from around the world this morning. In the group of 7 leaders look set to call on China to stop enabling and sustaining Russia's war against Ukraine when they meet in Italy from Thursday. That's according to a draft statement seen by Bloomberg. The document says Beijing's support for Moscow's defense sector has broad security implications. In response, the Chinese Foreign Ministry says Beijing is not a party to the Ukraine conflict. U.S. Secretary of State Antony Blinken has cast fresh doubt on the prospects of Israel and Hamas agreeing to a ceasefire proposal put forward by the U.S. He says the militant group wants changes to the plan endorsed by the UN Security Council, calling some of the latest demands unworkable.
Hamas has proposed numerous changes to the proposal that was on the table. I believe those gaps are bridgeable. Doesn't mean they will be bridged. We are going to continue to push on an urgent basis with our partners, with Qatar, with Egypt, to try to close this deal.
We're better just about across the board in the main benchmarks early on, north of 1% here. HSTech leading some of the early gains we're seeing here. And in a moment, you'll see what we're seeing, well, what's happening as far as EVs go. A50 futures also pointing to a strong start, and we should effectively be snapping this 3-day skid that we've been in here in Hong Kong.
Yeah, but as you said, it is that focus on the EVs and what we're getting in pre-market. So let's just take a look at those now, how they're faring so far. We saw Wall Street day, they closed a little bit lower. It has been a pretty big sell-off that we've seen over the past 2 sessions, really, for EVs. Here, though, you're actually seeing a bit of optimism going through, but perhaps there's all that negativity that's already been baked into the price.
That's right.
And as well, these tariffs, they were fairly well flagged, so you've already had that opportunity well in advance of this coming into effect. China property, of course, the other sector we're focusing in on today, because we've got the PBOC now urging efforts by the SOEs to speed up reducing inventory of houses. We are just seeing, again, those names moving a little bit higher so far today. Again, it's just another incremental step that we're seeing, but is that really enough to shift the needle here at all?
Yeah. Is it the real deal?
Yes. Whichever way you want to slice and dice it, but as we said, just ahead of the opens here today, and it looks like we're going to see a little bit of positivity, but of course, following that Fed decision, we did really see the stage being set for a move higher for equities across the board. You're watching the China Show. We'll have the open next. This is Bloomberg. Welcome back. You're watching the China Show, and we're counting down to the open of markets this morning. It's been a very interesting couple of sessions, really, for Chinese equities, because you've seen them really flirting with a few different key levels here, and really quite a sell-off that we've seen coming through as investors reappreciate or reconsider the risk to the economic outlook. What's interesting as well, though, is we're still starting to see people turn more bullish, and Societe Generale is one really standing out for their call yesterday, turning bulls on China stocks for the first time going back to 2022. So we've actually got SocGen here to talk about that. But Dave, really a lot to focus on, and not just that, but there's the geopolitical tensions as well.
Yeah, in the form of EVs today, right? So we were waiting for the announcement from the start of this week. In fact, from the time it was telegraphed that we might see higher tariffs, and in particular, right? So some of the automakers in China are getting hit differently. Excuse me. SAIC, for one, will show you that in a moment, and perhaps what we're seeing as far as stock reaction is concerned. Right. So a couple of things, right? So in case you missed it, other pieces of news other news out of China. So you have the PBOC yesterday coming out and saying they are supportive of SOEs helping out even further to reduce housing inventory. That's number one. You have this flattening in the yield curve, and as you can see here, that is certainly continuing to be the case. All that being said, though, when you take a step back, your 1-year yield is down effectively to the lowest in about 4 years or so. We've been steady in the 10-year since authorities have pushed back on this falling yield story. 159 on your screens. Iron ore and Shanghai crude on your screens as well. Flat open onshore. Right, here in Hong Kong. Big breaking news this morning, HKMA keeping rates unchanged on the back of the Fed coming through with their rate decision there as well. More on the Aussie employment in a moment there. There we go. As you can see, we are snapping, as of right now, that 3-day skid. Tencent rightly has, I guess in some ways, moved against the grain. So a lot of the rate-sensitive growth stocks in focus on the back of, I guess, what we're seeing as far as the Fed goes. Okay, I promise you EVs, and EVs are coming. SAIC, BYD, Li Auto, NIO, and XPeng bottom of your screens in a moment. SAIC is down against the grain 2%, BYD up 5%. So that's going to help lift some of the benchmarks that specific stock is in. Keep in mind, yesterday we did see quite a downdraft across these names, so we're simply offsetting the price move that we had yesterday. Further reaction coming through after that announcement. This is at the Chamber of Commerce in Europe, talking about how they're shocked and gravely disappointed. Okay, very, very quickly, a key technical level to watch these next few days or so, very, very short term. Hang Seng Index, we were down about 8-9% from the peak back in May. Very briefly below that 50-day moving average yesterday. That held, and as you can see, we're gapping higher ever so slightly today. Might be one to watch in the next few days as this index flirts with a correction, which should be around this level right below that. But as of today, we're up, Bell, 200 points on the Hang Seng Index at the open.
Yeah, we'll certainly want to know if we can move off that.
Yeah.
But a couple of data points as well to note. We've got Aussie jobs numbers just dropping here. We've got the jobless rate actually coming in line with estimates, so at 4%. That was, again, as we said, in line with what the survey had predicted here. Unemployment, or rather employment, rising, so nearly 40,000 jobs added over the month. That's higher than what had been expecting. And actually our Bloomberg economics team saying you've got to see at least 37,000 jobs being added each month for the economy to stay where it is. So we are holding above those levels. A couple of the more leading indicators that we track to see whether there is any sort of weakness coming through. You are seeing job ads. Those are starting to slow. You've got youth unemployment as well picking up. And then there's also people that are new migrants in the country are also taking longer to find jobs. So that's something else that perhaps just portends a bit of weakness to come. But for now, Aussie jobs coming in line with estimates pretty much. And as well, the Aussie dollar, we've seen it erasing those declines off the back, Dave.
Okay, let's turn it back to China right now. And as you can see, the Aussie dollar, as Bell was pointing out, also on the up. SocGen recently, yesterday, turned overweight on Chinese equities for the first time since 2022. Joining us here in Seth is Frank Benzimra, head of Asia Equity Strategy at the bank. As the Backstreet Boys, Frank, once asked and once said, tell me why.
Okay. Yeah. Well, first of all, so we downgraded on the outlook for China back at the end of 2022, and we thought now could be the right timing to do that. And the reason for doing it is, well, we have some tools, and we are a little bit rule-based, and then we look at what the risk-reward is, and just more specifically, we take the long-term growth, and if I cut it by 1 percentage point, I have a 20% decline, which is a lot. But if I just increase by 1%, I have 80% upside. And this kind of attractive convexity in the valuation was something that, well, of course, this is a model. It does not necessarily the reality, but it is showing that there is a lot of pessimism. And then looking at the latest earnings season, we start to see slowly, but we do see less downgrade in the earnings. We see some improvement in the sequential, in the quarter to quarter. And so we had a number of elements which, from a really fundamental point of view, are pointing to a better outlook. And then, well, we have seen as well the policy momentum, which is shifting, so the housing package back in last month. So putting all the things together, and also, because we have Asian portfolio, so also looking at the overall balance and how long this all tech is going to continue, then we thought, okay, we need to maybe take a little bit of risk off the technology sector and add a little bit more on China.
But tech in China as well has been one of the stronger sectors. So which areas are you looking at in particular then?
Yeah, no. So by tech, I was more meaning the AI-driven earnings. So this part of the market, well, we keep some overweight on Taiwan, but it was hard to have both Taiwan and Korea being overweight. And so this was also part of this of the thinking that we have around this change in allocations that we are making.
Just a housekeeping. You can just remove that earpiece you have. Yeah, I know. I can see it sticking out. There we go. Yeah, just to make you more comfortable.
Okay.
The premise of the call also is positive policy momentum. It's going to take a while, though, for the data to respond.
Yes.
So the question there is, can the market outperform while the data remains horribly unflattering?
Yeah, well, the data, whether you look at the sales, investment, even price, they are still on a year-on-year basis. They are still very bad. Now, what is important, as often in the market, is not only how bad the data are, but whether there is. If I can say the second derivative, the momentum is improving.
Okay.
And on here, well, we can have a little bit of expectation, but of course the crisis is not going to be solved today.
What about the things that are sort of more outside of China's control? And I'm thinking about, of course, there's the EV news that we're going to have extra tariffs being applied by the EU. There's the risk, of course, of further tariffs from either administration come November in the US as well. Does that play into your thinking, and do you see that as being a risk to the equity rally?
Yes, of course it is, and because you have a lot of uncertainty, and I think the biggest of the uncertainty is the outcome of the U.S. election and the trade policy in case of a Trump victory. And it's been part, of course, of our thinking, but now looking first of all of what happened. In the previous mandate, of the previous Republican mandate, actually MSCI China, as weird as it could happen now, actually did outperform quite handsomely the S&P during the period 2016-2020. And by this, I mean, of course, we have a lot of risk, but I think what really matters is the domestic economy and also the expectation. Back to your point on EV, we have some announcement yesterday from the European Commission, and I think overall increase in tariff is a little bit more than 20% if we average, which is more or less what the expectation were, between 20 to 30%. So we can see the market reaction today. Well, it's just one day reaction, but it's not a too bad market reaction.
I want to get your thoughts as well on other key markets in the region, if that's okay. So we have the BOJ beginning their meeting today, and who knows what it'll say tomorrow. You mentioned the yen is a problem now for Japanese equities. Just help us understand why it's a headwind at this point in time.
Yeah, well, let's assume the yen is remaining between 150 to 160. I say that will be a good bull market for Japan. Now, if we have the yen collapsing, then it's going to aggravate the consumer demand weakness and probably to postpone some recovery. If you have the yen recovering too quickly, then it's going to hit the profit. And now what we are seeing is, well, the Bank of Japan is making baby steps, and we might have another one tomorrow with some announcement regarding the government bond purchases, probably less being purchased. And even if we think that the carry trade is going to continue, and there is no reason that it should not, given the rates differential, we see some risks that the volatility of the currency, which has been so low so far, can start to increase. And this is where we are concerned, at least tactically, on the Japanese market.
India. Overall, that's a neutral weighting on your basket. So we're done with the elections. Not as powerful a mandate, but still a mandate to work with.
Yes.
Does this market still deserve that multiple premium?
Yeah, so well, for an equity guy like me, what was interesting is to see that finally valuation matters. So which is an important thing in India, and we can see that we can have some volatility when some unexpected event is happening. We are going to see in the coming weeks what will look like the third mandate of Modi, and especially we will have the budget coming. And well, we think that the overall story on India is remaining as a growth outperformance. So it's going to remain. But I think from a sector point of view, let's just be careful of the too highly valued stocks, and let's focus more on where we see some moderate valuation. Banking sector, for instance, is one that we put in our outlook. So that would be the allocation.
All right, Frank, thanks very much for your time this morning. That was Frank Benzimra, the head of Asia Equity Strategy at Societe Generale. And let's stick, of course, with the China theme, because our Bloomberg opinion columnist Dan Moss thinks that inflation in the country is worryingly low. And he also thinks that officials should flex some monetary muscle to juice its economy. He joins us now. And Dan, of course, the numbers that we got from deflation weren't really good either way you looked at it. We saw PPI, of course, in contraction for a 20th straight month. You saw the CPI fractionally high, but just 0.3%. So definitely there's very weak consumer sentiment. But against that backdrop, what's really the willingness, do you think, of the PBOC to act here, given they've been quite cautious so far?
Well, the PBOC is doing a great impression of a glacier, and one that's not melting. The question is, how long can we go without at least some acknowledgement from the PBOC that inflation is way, way, way too low? Now, as you said, the economy in China appeared to get off to a pretty good start relative to how disappointing last year's performance was. And it's true that CPI is now the right side of zero, but it is barely the right side of zero. It's going sideways at best. Now, if you look at some of the other major economies' experience with too low inflation in the past couple of decades, they have seen merely the risk that too low inflation turns into pronounced deflation as reason enough to undertake a significant policy move. Now, China announces its main lending rate on Monday. Every month, this MLF rate comes around, and people ask, well, could this be the month they do something? Crickets. You know, it's time for them to step up. Now, cynics would say, look, what's 10 basis points? By the way, that amounts to a big cut in China. What's 10 basis points going to do with deeply entrenched challenges that have built up over the decades? It's not going to turn things around. Well, no, but the signalling intent is important, that they're on the case.
Yeah, Dan, you make a very good point. You know, the context is key here. When you take a step back, you know, what really is the difference between 0.1% to 0.2%, say? I'm just picking random numbers there. But as far as markets go, also sometimes it's the quantum and the delta in that change, and people trade on that, and the market can, say, outperform. Aren't you being too harsh?
Possibly. But look, this is not a situation that policymakers in China can feel comfortable about. Now, what are the things that could be hampering the PBOC from taking a more proactive approach? Well, they don't enjoy the same degree of autonomy that the ECB or the Federal Reserve do, but they are a player at the decision-making table, and it's the quantum. 10 basis points here, 10 basis points there, another couple of 10 basis points move over the 12 months or so. And then you've got, by the incremental standards at which policy moves in China, a not insignificant effort to boost the economy. But again, it's about the signaling. So if you've been on pause for a long period of time and then you make a move, it's rarely a one-off. You don't, get off the stump just for one thing. It's typically part of a series. no matter how much people like to sort of distance themselves from that idea in the moment.
The title of the column, Dan, is China Should Flex Some Monetary Muscle for Bloomberg clients and BOGO, of course. Check that out. Dan Moss, thank you so much. Bloomberg opinion columnist in Singapore for us there. Plenty more ahead here on the China Show. Markets are mixed. Onshore equities somewhat under pressure. We're still seeing some gains, though, here in Hong Kong. This is Bloomberg. We're just coming off highs of the session, about 17 minutes into the the goings here. So HS Tech was a case in point, was up as much as 1.3, 1.4%, just now better by 1%. And Hang Seng Property Index now done half of 1%. Broadly speaking, though, it's generally a risk-on session. So you have Japan, BOJ starting its meeting today, and in South Korea, this one coming through we want to watch today is that this discussion on whether they will be lifting this short selling ban. So discussions, I believe, are set to take place today.
Yeah, but broadly, I mean, look at the session today. You're moving higher, and it's really just a story of the Fed and the inflation numbers. Of course, we saw that retreat in inflation. That was good news for the Fed and FOMC officials going into that meeting. And of course, maybe not the amount of rate cuts that were previously expected for this year, but still the stage is set there. And you saw Treasury yields lower, weaker dollar. That's all a supportive environment for stocks. But earnings is the other focus. And we were just speaking with Frank Benzimra from Cheng, saying that they're starting to see some green shoots appearing in a lot of different names. The question for Chow Tai Fook, what they get.
Yeah, what sort of gems are we going to find in that company's results? Let's bring in Catherine Lim to talk us through this. Yeah, so Chow Tai Fook set to report today. How high should I set my bar?
Well, David, gems, I think, all eyes are also going to be on gold, because that still accounts for more than half of Chow Tai Fook's sales across Greater China. So at the levels that gold is hovering at right now, the real question really is that are shoppers in Asia and Greater China still buying gold? So we're going to look actually for the indications from the companies, and I do expect that the high gold prices has inevitably hurt some of the purchasing inclination. I think shoppers will be out for actually gold to actually recede a little before going into this precious metal again as a hedge against the inflation. And to what you've actually highlighted on gem set or diamonds, are shoppers really buying diamonds just when consumer sentiment isn't all that rosy? So that's what we're going to be looking out for tonight.
And of course, at Chow Tai Fook, it's very present across the city, but like a lot of other retailers, maybe has been hurt a little bit by the amount of people that are choosing to shop instead in mainland China over a weekend. Is that going to show up in the numbers?
Yeah, Annabelle, that's a good question. I guess the good about gold, and really it depends on, the ticket sizes. If it comes in a little larger than, what you're looking at itself, it still does make sense given that the tax prices in Hong Kong, it's still relatively, more affordable or rather lower than what you get in China. But that said, do actually factor in, the strong dollar that has hurt currency from the Chinese shopper's perspective. So again, depending on, which side of the, boundaries or the borders you are at.
All right, that was Catherine Lim there, our Bloomberg Intelligence senior APAC consumer analyst, talking about Chow Tai Fook earnings. Those numbers are due out later today, but we'll have more ahead. This is Bloomberg. Well, we are taking a look at some live pictures here going to Wellington in New Zealand here. We're just awaiting a welcome ceremony for the Chinese Premier Li Cheng. He is due to arrive perhaps in just a few moments here. But of course, those tensions or what has really been sort of a shifting focus in New Zealand's foreign policy back toward the US, back toward its key allies, has perhaps stoked some of the ire of China in the past. But this, an important visit, of course, to track.
Yeah, and then after this, of course, he moves on to Australia.
Yes.
Right? After that. I believe it should be the same trip. Can't believe they're going to fly back to Beijing and then come back. Anyway, okay, I'm just making my own itinerary and what I would do. Thank you so much for the pan. There we go. Panning back to markets, we're looking at EVs. So you have BYD up now 6.7%. So a good day to be long the stock. A lot of you are long, I know. Heavy weighted stock. The ticket size though to get in, right, on a retail basis. Steep, right? Where you are on the block. Okay, Geely 1.7%, and we're also looking at Gansu Energy Chemical, down about 4.5%. Right, Quantum Pharma is a trading debut today. Let's get that up, please, if we can. There we go, up 17%. Here in Hong Kong. So first good day at school. In fact, the price is almost exactly the date, 6:19. It's 6:13 today. Okay, going into global macro movers, risk on session. So you're getting a lot of the benchmarks that are skewed towards these growth and rate sensitive names seeing the most upside. So Korea's one, Taiwan is another, HS Tech is another one there as well. Maybe on the prospect that rates eventually will come down, and no nasty surprises there out of the Fed.
Yeah, that's right. And of course, we're tracking the outlook for China's economy. We're going to be hearing from the DBS China CEO just ahead. Welcome back to the China Show. Here's a look at the HSI half an hour into the session today. We've got pretty much every single sector in the green so far. But there's actually a sort of a confluence of factors that I think are helping equities in the session today. Firstly, you had, of course, the Fed meeting and inflation figures that were supportive for equities, and we can get to why in just a moment. You've got, adding to that, the EV story in China, and actually the tariffs are pretty much coming in line with expectations. So you're seeing those EV stocks moving higher. And then thirdly, as well, we actually had some better tech news out of the US because Broadcom came out with its numbers. It came out with a 10-for-1 stock split.
Yeah.
That helped a lot of the tech sector. So really, there's a lot of tailwinds pushing Asian equities in the session.
Yeah, to your point, I think Oracle also did very well overnight. NVIDIA, of course, continued to see those highs as well. And, no nasty surprises also coming out of the Fed, right, as you were pointing out there as well. So maybe there's a lot more visibility around the rates cutting cycle when we get to it at some point. 1 or 2 is still 1 or 2 today. Hang Seng Index on your screens. Bloomberg Dollar Index over 3 days, just to show you where we are relative to this time yesterday. Then we had an inflation print, and then the pickup slightly, not so much to completely offset the move. Similar move in 2-year yields, which you'll see in a moment there. So big dip following the CPI print, and a bit of a pickup following the hawkish dots, if you can put it that way. Although, if you think about it, they simply took one cut this year and just moved that into next year. Although a higher landing, of course, as far as the neutral rate is concerned. S&P futures over 3 days, similar look here, although it's the opposite given, of course, the dynamic and price there. Up, and 50... record high, effectively. There we go, on the S&P. 5,400 for the first time in forever.
That's quite a dateline. All right, Fed officials, as you said, penciling in just one interest rate cut this year and forecasting more for 2025 instead. Chair Jay Powell says inflation is easing but remains too high.
We see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time. And we have to deal with that uncertainty around data. The policy is restrictive and is having the effects that we would hope for. We think we're getting the things that we would want to get, broadly speaking. Rate cuts that might have taken place this year, take place next year. We'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks. Really, the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions.
For more context, is Mark Cranfield with us right now out of our MLive team, of course, in Singapore. Mark, did the Fed or did inflation, let's look at those two factors, set up the second half very nicely for risk assets?
Probably more to do with inflation, and I think you have to probably separate the reactions, because I think what you've seen in the past few hours may not last in terms of all asset classes. So let's start with equities. I think the message that equities saw from that really was that the Fed is no impediment to future growth in the equity market, particularly in the US, obviously. You've got very strong stories coming through, particularly related to the AI sector. Broadcom is yet another example of the good things which are going on in that sector. So from equities' point of view, what they heard from all of that was that there's no way the Fed is going to increase interest rates again. At some point, they will lower interest rates. Whether they do one cut this year or they don't do any, doesn't really matter a great deal to the equity market, which is focused on a much bigger and stronger story than anything to do with short-term interest rates. As far as the bond market is concerned, they get a little bit of a help from the weak CPI number, and they're extrapolating to think there'll be more of that coming in the second half of the year, so they can actually price in more than one cut in the market. But we're likely to see some very choppy trading in bond markets for several months, as we've been seeing really for most of this year. Just because we had one set of CPI numbers that was good, bond markets will respond to each set of non-farm payrolls, CPI, PCE, as they come out over the next few months. We can expect pretty choppy trading there, even if the equity market stays fairly firm. And then you've got the US dollar, which initially sold off a little bit related to the combination of the Fed and the CPI, but it's still got to get through the Bank of Japan tomorrow, which could completely change the whole picture if dollar yen goes back towards 160.
What's the likelihood, Mark, do you think, of that happening?
Well, typically, we've apart from that one March meeting where the Bank of Japan did raise their rates for the first time in many years earlier this year, and of course that was finally telegraphed through the local press stories, generally the Bank of Japan has disappointed market expectations. So a lot of traders go in to Bank of Japan's meeting think there's going to be a big recovery for the yen, something maybe significant in the Japanese bond market as well. And by the end of the time of the statement coming out from the Bank of Japan, and then the press conference from the BOJ governor, we end up with dollar yen being higher on the day. There's a pretty decent chance the same thing will happen again tomorrow. Most people don't expect the Bank of Japan to change policy. That's not a huge surprise. But they are expected to announce something in terms of reducing bond purchases. But if they go by their track record of recent months, they will probably not do enough to satisfy people that want to see a stronger yen. It will come in below expectations on that front. So it's quite possible by Friday evening, dollar yen will be higher than it is today.
Mark, just a quick word on China, which has taken a back seat. Certainly, news flow-wise, what have you, price-wise, hasn't really done anything of late. How are you thinking about China now going into the third plenum next month?
I think we're going to go back into a situation. We're seeing a bit of green across China markets, as you mentioned earlier today. But I think we're going to go pretty soon back into a situation where China lags behind the major markets around the rest of the world. The story for global investors, the US story especially, and to some extent the European story, is so powerful. The tech companies are making so much money. It's such a positive narrative out of the US. As a global investor, people will want to remain overweight as much as they possibly can in the US. China is a much more murky picture. It's much harder to figure out what's going on. There's uncertainty in terms of transparency. Then you've got sanctions being put on by Europe and by the United States. It's a much more difficult place to make an assessment, and the Chinese currency is not in a particularly good spot either. So if you put all that together, we're probably going to go back to a situation we saw in the middle of last year, where global funds will just shift away to other places. Of course, there's a domestic market in China, but that alone can't support it too much. We're probably going to see divergence with China underperforming the rest of the world.
All right, probably not what Chinese policymakers want to be thinking about, but we'll get more on that, of course, ahead. That was the MLive strategist Mark Cranfield there, but we're going to be getting more on the macro outlook for mainland China as well, because DBS China is joining us, why they see consumption being a key driver for the GBA. This is Bloomberg. All right, you're taking a look at the welcoming ceremony for visiting Chinese Premier Li Cheng in Wellington this morning. He has arrived in New Zealand for 3 days of talks and meetings there. New Zealand, a country that, of course, has sort of shifted its tone on China since the last time a Chinese premier visited back in 2017, and we really have seen that toughening in stance. But that's what we're going to got there. We'll leave it now, but of course that focus still on China and its relationships with other parts of the world as well.
Yeah, particularly when trade, external trade and exports is becoming an increasingly important part of the recovery recipe.
Yeah, well, you've got to export out if you're not going to get the growth at home.
Yeah, which you're not getting so far as well. So Premier Li, of course, is there today, and I think in a couple of days, of course, he then moves on to Australia. Let's get a sense now, though, of where this domestic economy is in China. In fact, let's bring in the DBS China CEO joining us out of Shanghai, Ginger Cheng. They recently, of course, just concluded their conference. More on that in a moment. Ginger, good morning from Hong Kong, and a pleasure to have you, and thank you for joining us today. I wanted to start off with the economy, if that's okay, and what you're seeing from your perspective. Are things improving? If they are, to what extent are things improving? Or if they're not, why not?
Good morning, David and Annabelle. Thank you for having me. I'll say that the economy in China showing steady progress, mainly driven by strong export, fueled by the increasing external demand. Domestic consumption is also showing some improvement, especially for tourism and for consumption. Investment side, as we all know, that real estate investment is still very weak, but the government is channeling a lot of resources, continue to do infrastructure investment, and hopefully that will fill the gap left by real estate. So as you just mentioned, that we just completed our the fourth GBA conference in Shenzhen. So we have 500 plus business executives from Hong Kong, Macau, and the Guangdong cities to join us. So one of the focus of the conference, in fact, is AI, Gen AI innovation. So I think that could be a new energy and the new development area for China, especially for GBA area. I just give you a figure that, in fact, in Shenzhen now they have over 1,900 AI-related companies, and as you all know, that GBA is also fueled by the technology innovation. So I think that will be the new source of development for China, especially for GBA.
But of course, tech and generative AI really relies very heavily on AI chips, and this is something that's been a key point of tension. So what was the discussion around that at the conference, this risk of because even as that conference took place, or just after, we had the news that the US could be looking to further restrict China's access to those key technologies?
Yes, we all acknowledge that the constraint of having the more advanced chips will be a constraint for the development of AI and Gen AI in China. However, very similar to internet, I think China will develop their own routes and ways to develop AI and Gen AI. So according to the expert and industry people attending the conference, the focus of China's AI, Gen AI is more on the application side, and especially application related to certain industry segments that China are very good at. So I think they will find ways to get around that. But I also acknowledge that there will be some catch-up to do if with the constraint of the chips, for sure, yeah.
As a bank, how are you looking to get involved there, if at all?
Well, for DBS, we started to look into the strategic industry segments a few years back, starting from the EVs and then renewables. And now we also set up a new economy group in both Singapore, China, and also other locations to target the new startups, mainly on the technology innovation side, the digital economy side. Hopefully, we could onboard those customers in early stage and then help them to go through their life cycles by providing different kind of banking product and services. So, for example, for some of the AI companies, they are already going out, meaning that they set up offices in Singapore, Hong Kong. So we are also helping them to set up and develop in overseas market.
Right, Ginger, if you could tell us more, that's interesting because typically, you would know, I mean, banks typically don't get involved as directly with, when a company's in its infancy or these startups, for example. So are you looking to extend credit? Like what sort of relationships are you looking at to make with these small, maybe future giants, but for now, of course, still developing?
In fact, we are providing different banking product and services according to the life stages of those companies. For new startups, in fact, they don't require credit. In fact, the most of the capital, in fact, are from VCs. So we work very closely with the local and also international VCs, and we start from opening account with them, handling the capital injection, the FX and cash management. And later, when they are ready for more fundraising, we also act as a financial advisor for them to raise capital. As you probably know, that DBS and Temasek also set up a debt fund called Evolution X that will provide the so-called development debt to the new startups that will help them to avoid dilution of the capital. So as I mentioned, that we'll provide a different banking product and services, also in onshore in China and also in overseas market that those startups choose to operate.
We have seen pretty weak credit demand in China. What's your loan book looking like right now, and that willingness to bank new customers that perhaps wouldn't have been so bankable in the past? Is that about trying to offset any weakness that you do see in the loan book?
I would say the overall demand of lending loans in China is not very strong. But for certain segments and for certain kind of opportunities, we still see quite a strong demand for loans. For example, for DBS China, we see a moderate growth of loans starting from this year. And it's mainly from a few strategic segments. Renewables is a major a segment that we target, and also EVs and metal and mining, which is also related to EVs. Now they become one value chain. And also, I see very strong demand from the companies going abroad. I think this wave of Chinese company going global is quite different from One Belt, One Road back to 10 years ago. Now the industrial companies, technology companies, high-end manufacturing companies looking to set up manufacturing and R&D facilities in ASEAN, in Latin America, and also in East Europe. So these opportunities, in fact, provide quite a lot of banking-related opportunities for someone like DBS. We supported a lot of clients going to ASEAN, and I see this will continue to be a major trend for the coming 3 to 5 years. Under the backdrop of more trade tariff and constraint imposed by EU and US.
Ginger, just a final word on wealth and what your plans are, particularly onshore. You know, the battle for wealth is something that seems to be cycle and political cycle agnostic. What are your big plans and what are your specific targets for your group? Okay, for DBS China onshore, we
are targeting the relatively high net worth customers with AUM of over RMB 1 million with us. So I see a very strong trend starting from last year that a lot of high net worth individuals in China that they are looking to diversify their onshore wealth. Of course, some of them may have wealth outside China, but they still have a substantial portion of the wealth inside China. So they realize that there are good opportunities in the offshore asset classes. With, for example, US dollar deposit, with the treasury bills, with the fixed income, and even with the equity in US and Europe. So DBS with the product structuring, with we also have a QD granted by SAIC, so we can fully utilize those to help our local Chinese high net worth to diversify their investments. So I see very strong growth of new customer and new money onboarded starting from last year. And this year, the trend is also very, very strong.
All right, Ginger, that was Ginger Chen there, DBS China CEO. And we're going to leave you now, going to our break with some live pictures of the welcome ceremony for visiting Chinese Premier Li Cheng. He is making, or on his first visit to New Zealand for a Chinese Premier going back to 2017. You can see him there with Prime Minister Christopher Luxon. Of course, we've been noting New Zealand's shifting foreign policy and now getting a little bit more hawkish toward China. So, as we said, that welcome ceremony for Premier Li Cheng visiting New Zealand. We'll have more ahead. This is Bloomberg.
All right, the glance at equity markets right now, 0.7%. So we are continuing to just ever so slightly gradually come off highs rather on this Hong Kong benchmark. We've been at these levels on the CSI 300 for the better part of the session. And of course, out of Korea, the news lines coming through here is that the timing on being able to put in place again the short selling mechanisms is still up in the air, at least for now. Right. The other big story that's one of our Bloomberg scoops early on and just away from the public markets is PAG, of course, which is a household name in the private space, of course.
Yeah.
And them not, according to reports, them not being able to meet that fundraising target of, I think, $9
billion. That was announced when 2 years ago when it initiated. The target. So last year they actually revised it down to the $6 billion mark, and now we're hearing it's around that $4.5 billion. I think it's very interesting because you look at PAG versus its peers, and what PAG hasn't been willing to do for a variety of different reasons is to put a cap on how much it will invest into mainland China. And so ones that have been willing to I guess, work with investors who are feeling pretty insecure have performed a little bit better. But PAG as well, also really interesting to notice where it's getting that funding from. It's for investors in this part of the world, and it's also coming from the Middle East, and we continue to track that growing relationship between here and the likes of Dubai, for instance, Abu Dhabi.
Right, and I think to the point you're making there is because the previous source of a lot of the funding and fundraising was in the U.S., right? So U.S. pension funds, for example, and maybe them not putting a cap, or at least willing to put a cap on the exposure to China, might be just pivoting some of these investors away. But yeah, we have the full story, by the way, just for Bloomberg clients, in case you're curious.
Really
on that
worthwhile reading. Yeah, very interesting.
Yeah. We could not possibly do it justice in 90 seconds.
Definitely not.
But there we go. That's a tease for y'all, as they say. Okay. Yeah. Let's have a look at markets, chip stocks across the region. Yeah, well, chip stocks that we were talking about before as well, because there's a couple of different stories we're tracking today. There's Broadcom, of course. We had those numbers coming out, and we saw another evidence that AI demand is going to be booming, at least the demand for the chips. The question is, are we seeing enough AI profitability coming in for companies? And that might start to moderate the demand, but we're not seeing it just yet. So good numbers for Broadcom. You were mentioning Oracle before as well, but that is playing out very much in the chip space this morning, and you're seeing that moving higher. Big moves as well, what we're seeing in the EV space so far, Dave. Yeah, so BYD is continuing to push higher, 7% now. So just keep in mind, of course, some weakness overnight in BYD in the U.S. SAIC, of course, is really, I think, which I wouldn't say came out of the blue, but certainly the figure that the tariffs, the tariffs attached to SAIC was some of the worst hit, if not the worst hit, in terms of revenue exposure in that. Kospi index, we talked about short selling. What you might have missed, I think, BTS, the K-pop, I think they're not complete. I think Jin has made it out of his national service. I just saw it on social media. Random information for y'all. This is Bloomberg.
It's 11:29 a.m. in Tokyo. We've got Japanese markets going to break in just under a minute's time. Of course, it's day one of the two-day BOJ meeting and question marks over perhaps not really policy so much, but it's really the timing of when we're going to see that further exit away from negative rates.
Yeah, and also the bond buying, right?
Yes,
and to what extent they'll be reducing that. I can barely sit through a 1 hour meeting. Imagine sitting through a 2-day meeting on a regular basis.
There's a lot to get through. You've got to know, are we seeing the sustained growth coming back in? Inflation, what are they actually passing through the numbers? You haven't got the national, there's also the Tokyo ones to watch as well.
Yeah,
lots going on.
Yeah, well, fascinating for some, I guess. Earlier on, we had a conversation on this market, really, and the yen dynamics as it pertains to the equity markets. So SocGen and the head of Asian equity strategy, Frank Benzimra, actually gave his assessment. He thinks it's not the Japanese yen and the volatility around the currency now likely presents a potential strong headwind here for the equity market in Japan. Have a listen to how he phrased that conversation.
The Bank of Japan is making baby steps, and we might have another one tomorrow with some announcement regarding the government bond purchases, probably less being purchased. And even if we think that the carry trade is going to continue, and there is no reason that it should not, given the rates differential, we see some risks that the volatility of the currency, which has been so low so far, can start to increase. And this is where we are concerned, at least tactically, on the Japanese market.
Yeah, of course, and what we get on terms of bond buying, any sort of signals on the rates outlook is really going to feed into the currency move. And we were just speaking before with Mark Cranfield, the chances we could head back to that 160 mark. But Bloomberg's Sherry Arn, she's been taking a bit of a deep dive into the implications of that weaker currency and what it means for the country.
Japan is back, attracting people from all over the world with unbeatable deals.
The third time I came, the yen is now very good, so I eat now very, very low cost. And I came here with a backpack with 10 kilo, and now I'm going home with a backpack for 20 kilo, because all clothing that I bought because it's very cheap.
The Japanese currency is trading at levels not seen since the 1990s, and tourists are taking notice.
The Ginza district here in Tokyo has for years been a byword for luxury, just as the rest of Japan has been known for its premium experiences and goods. But with the dollars, pesos, and yuan going much further, plus the 10% duty-free discount, luxury is at a bargain.
But it's not all glitz and glam. For Japanese households and smaller businesses, a cheaper yen has meant real pain.
The price of chocolates and oils has gone up so much. We try to keep the quantity of breads with them to a minimum and make simple breads without imported ingredients.
Companies that depend on imports and rely on the domestic market are suffering from higher costs. And even exporters that would typically welcome a weaker yen are growing uncomfortable. The currency's sustained decline is making business planning more difficult.
A big factor is that when M&A is conducted overseas, we're not purchasing with yen but with local currency. When the price is set in dollars or euro, it becomes much more expensive than when the yen is strong. This has had a significant impact on our business.
And for Japanese towns feeling overrun by tourists, the cheap yen is triggering other interventions. Fujikawa Guchiko has erected a giant black screen to block its iconic views of Mount Fuji. Sherry Arn, Bloomberg, Tokyo.
Let's continue the deep dive into the Japanese success story and this emergence out of these lost decades. Let's bring in our Bloomberg Intelligence senior industry analyst Takeshi Kitaura, who joins us right now to talk us through the equity market, the sectors that are winning as things start to emerge in the land of, again, the rising sun. Takeshi, rates are rising, wages have gone up. Can Japan head towards this inflationary market?
Yeah, so I think the important thing is continuing to increase in wages. So we saw Shunto wages go up over 5%, but continuing that is needed to boost consumption going forward. So we have seen a decade of low consumption, so to change that, it's pretty difficult overnight.
What about the focus on digitalization? Because Japan's really been perhaps a leader in this area. So how's that faring, and who are the winners and who are the losers in that?
So for digitalization, I would say Japan has traditionally been a hardware-oriented economy, with cars being one of them. Now a lot of companies are moving to digitalization, and 2 points. One is to internally make the processes efficient for the company itself, but also as a service. And one company that I oversee is Hitachi, which has, through their IoT platform Lumada, they're getting adjusted EBITDA margin of 15%, which is much higher than the company average of just below 10%.
And the other growing area of focus has been on high-end chips, and Japan's tossing its hat back in this sort of very lucrative ring, as they say. What are some of the strengths and challenges that you see here particularly?
So the strength has always been in the chip manufacturing tools. For example, Tokyo Electron, you need these equipments to manufacture high-end chips. Also the materials, wafers with Shin-Etsu, for example, capacitors with Murata. So these companies need to support the industry to grow further. The challenge for Japan would be to actually produce the chips, the 2-nano chips that Rapidas is currently trying to get to, without having produced the 7-nano or 5-nano chips in the past.
What about shifting a little bit from chips and tech to a different type of advanced manufacturing, because there's the defense side as well, and Japan is really stepping up as quite a major defense player globally. How is that industry developing in turn?
So defense is an interesting one. As you say, it used to be about 1% of GDP in terms of the government spending. Now they're trying to get to 2% over the course of next 5 years or so. Another factor is the margins. It used to be more like mid-single digit in profit margin. The government, through the expansion and also the increase of the margins, the outlook is moving towards a double-digit margin for the industry. And Mitsubishi Heavy, for example, is one of the major contractors for these equipment. So they have seen orders spike, and the orders have led to higher margins for these equipment as well.
That was Bloomberg's Takeshi Kitaura there. We'll have more ahead. This is Bloomberg. Well, the PBOC is urging banks and government departments to do more to tackle the property crisis. The central bank held a meeting yesterday with major lenders and government officials, telling them to broaden their thinking. Let's get more now with our Bloomberg Intelligence analyst, Christy Hung, joining us. And Christy, is this going to be effective, do you think? Are people really going to be, as we were just saying, they're really heeding the call of policymakers?
Right, yes. Our banking analyst was in Beijing last week, and he was speaking to the big state banks. And the state banks, what he's been hearing is that the state banks are saying, the plan is still in a very preliminary stage, and they have not been extending new lending based on that. I think the slow pace of implementation is concerning for the central bank, which is why now it's pleading for more efforts to speed things up.
And why do you think there is friction? Why is it difficult or complex to get, local governments or the banks on board with the plan?
Yes, I think when the policy was announced in mid-May, we wrote a note saying that this is easier said than done. And we do need the stars aligning for this to happen. And especially on the local authorities' part, public housing in China is not profitable. If you look at affordable housing for rent, the yields are very low, then it demands a long payback period. If you look at affordable housing for sale, there's weak demand in the market, and that's coming from weak buyer confidence. That is still a problem. So I think this is why, from the local authorities' part, there's very little economic incentive to implement this. And if you look at the developers, a lot of them have already pledged the unsold inventory for bank loans. So then they might not want to actually sell these to the government. And then they might also not want to offer steep discount for these unsold homes that they have.
As we see a lot, not just in China, but anywhere really, you can lead a horse to water, but you can't make it drink. So is there a different policy that you think would be more appropriate then? Or is this the right policy? Because if it's not working, then what's the outcome?
Yes, I think restoring demand-supply balance in China is still a very difficult task. And if the structural problem of oversupply continue to persist, then we have, very weak home buyer expectation of home price increases. And then I think the fundamental issues that we are seeing is still the economy is weak and people have very low confidence on the stability of the jobs, the stability of their income. That's why they're not committing to buying a home. So I think we continue to think that we need a few quarters of better than expected economics data for people to improve the expectation on their jobs and home prices to get in the game and buy homes again.
Yeah, we've known it's gonna take time. Christy, fantastic. Thank you so much, Christy Hung there, our Bloomberg Intelligence analyst. Right, a glance at markets. Hong Kong is higher, but I wouldn't say just barely, but certainly coming off highs of the day, 0.5% here in Hong Kong. We're now pushing towards 0.5% lower on these onshore benchmarks. 12 points to the downside, CSI 300. This is Bloomberg.
All right, taking a look at some other news that we're tracking this morning, and protesters have taken to the streets of Argentina as President Javier Milei tries to push his signature reform package across the finish line. Debate in the Senate is continuing, with the most important fiscal measures facing strong opposition. Milei's party has already modified the bill by removing state-run airline Aerolíneas Argentinas from the list of firms facing privatization. Group of 7 leaders look set to call on China to stop enabling and sustaining Russia's war against Ukraine when they meet in Italy from Thursday. That's according to a draft statement seen by Bloomberg. The document says Beijing's support for Moscow's defense sector has broad security implications. In response, the Chinese Foreign Ministry says Beijing is not a party to the Ukraine conflict. Fired SpaceX engineers have filed a lawsuit against Elon Musk in California state court, alleging sexual harassment and retaliation. 8 former employees say Musk posted sexual photographs and demeaning commentary and chose to fire employees for speaking up. SpaceX has previously denied wrongdoing and said that Musk was not involved in the workers' terminations.
Okay, yeah, just look at markets right now. So we're coming off a Fed's meeting, which, to be completely honest, was, I guess, a blessing for markets because it was a nothing burger. Are you better off in terms of the amount of information you have now compared to this time yesterday? Maybe not. I mean, certainly they moved one hike, which was supposed to be this year. You turn the calendar, but that shows up next year. The higher neutral, I think, is perhaps even more key here. Equity markets are cheering this on. I think, okay, global macro movers, can we switch off the closed markets moves here, because this is showing Europe, but, well, I guess the approach to the Fed meeting was a good day in Europe, a good day in the U.S. We are on better footing here in the Asia Pacific. Thank you so much. Yeah, there we go. Click that. There we go. Yeah, thank you so much. Okay, right. We are talking about EVs. Okay.
Yeah, well, the EV story is very interesting because, as you were just noting there, BYD's on an absolute tear, and it seems like all of the expectation around tariffs, that it's sort of been priced in already, and that's why we're seeing that move to the upside so far, given that, tariffs of around 20% was sort of already factored in. But we've got car makers, BYD, Geely, SAIC, notified and expected to be impacted from July 4.
Yeah. BYD, I'm looking at that, to Belle's point, right? The best day in about a year or so. In fact, let's bring in our Bloomberg Intelligence Asia Auto Analyst, Cheng, joining us right now. Well, how big of a problem is this, based on your calculations, Joanna? Who gets hurt the most and who pretty much brushes this off?
Hi, thanks for having me. So tariff news is in general bad for the industry overall. But what's interesting is that EU actually applies different duties for different car makers. So you'll see that even though the industry average is 21%, some are getting lower, like BYD, and only 17.4%, and some are getting as high as 38%, for example, like SAIC. So what we're saying is that it's actually not that bad for BYD, because if you think about it, BYD has the highest profitability among all Chinese EVs, and right now it's getting almost the lowest tariff hike for their EU imports. So actually, we think that BYD can absorb most of the extra cost burden that due to this tariffs, so that it should be able to make sure that its vehicle prices in the EU is stable, that don't really hurt demand. And also, if you think about the BYD sold 3 million cars last year globally, and the BEV deliveries, which are subject to the extra tariff, is probably only 1% of its global sales. So the profit impact is small. But if you look at SAIC, then that's a different story. SAIC is heavily dependent on the EU market, and its BEV deliveries sales exposure is high there. So SAIC is under the largest profit blow due to this EU tariff.
Okay.
We have seen some of the Chinese EV makers setting up production facilities in Europe. Do you think that we'll see more of this? Is this going to really coax them to play ball, I guess?
So actually, Europe is still a very large EV market and also a lucrative market over the long term. So the Chinese automakers, it's unlikely they're just gonna, hey, I'm gonna give up the EU market because of the extra tariff. What they'll do probably is that they'll have 1-2 years that's really tough through probably 2026, because they don't have a local factory there yet. They still need to get the factory running and then to have local production so that they can bypass the tariff. And it's also not only about tariff, it's also about you're building your brand reputation there, having more marketing events. So that's all going to take time. So the next 1, 2, or even 3 years could be a little bit slow and tough for the automakers, but they will still they are probably also still determined to expand their presence in the Europe once they have the local factories up and running.
All right, that was our Bloomberg Intelligence analyst, Joanna Chen, there. And as we're seeing, really a pretty strong day for Chinese EV stocks so far. What else we're going to talk about is...
animals. Cute puppies.
Yep.
Pugs. Kittens.
Well, you know, I mean, we talk so much about the slowdown in China's economy and why the likes of EV makers need to look for growth in markets like Europe. One sector, though, that is doing much, much better is when it comes to pets and animal care in particular. And there's actually a new report out from Bloomberg Intelligence saying that it's going to hit nearly $50 billion by 2030. That's as fur babies, as they're known to some people, emerges the new proxy for children. Let's get more now with our senior analyst, Ada Lee. And Ada, I mean, talk us through it, because of course we know people love pets, and it's not a China phenomenon, it's a global phenomenon.
Not everyone, but yeah, okay.
Okay, well, yeah, but hopefully people love their pets because they've chosen to get them. But what stands out in China's market in particular when it comes to pets?
Absolutely. So we are expecting the Chinese pet economy to grow by 6% a year to 2030, and that is almost double the projected GDP growth for the country. country and reaching about $49 billion in 2030. And that growth is mainly driven by, firstly, shifting demographic. As more people are becoming more reluctant to get married and have children, we have seen that in the demographic data, in recent years, that's just been on a decline. Very similar pattern like Japan and South Korea. And we're expecting the increase in number of single elderly people as well as very busy individuals that are working in cities. They are going to look for companionship from these furry creatures. And we expect them also to increase their willingness to spend on these animals as they get older and as they become part of the family.
Yeah, well, if not already, right? And is the case also we're seeing in Japan, for example, where we know, of course, the demographics are the most extreme version, I guess, of just really bad demographics, but that doesn't mean there are no, furry friends around.
Correct. So in terms of Japan, it's a very interesting case because we are not really expecting them to grow. We're expecting more stabilization in the Japanese pet economy. And that's because they have already seen the pet boom back in 2003 when it was the first time ever that the number of cats and dogs in the country outnumber the number of kids under the age of 15. So it's a staggering number to see when you have more cats and dogs running around in Japan than kids.
And Dave talks about the extreme demographics, but I think actually South Korea is perhaps even more extreme when it comes to an aging population and a declining birth rate as well. So are we going to see that sort of thing? And what sort of spend is it on pets?
Correct. So in terms of South Korea, we are seeing similar pattern. And what we are also seeing in addition to the demographic tailwind is the fact that firstly, they are banning the dog meat trade by 2027, and that will boost the pet economy. And also there are some government-led initiatives, such as they are looking to abandon the value-added taxes on essential pet vet services. So that can also lower the pet keeping costs for South Korean.
Yeah, I think, a case in point, and this is an example close to home of just how much people spend on their pets, right? So I think this is a video actually of one of her producers in her pet farm at home, and just a ridiculous lifestyle that, her pets actually enjoy more than humans.
Luxurious lifestyle. I think we're making the point that the pets have a better lifestyle than some of us humans.
The pet food industry is actually a massively booming industry, and these pets are not eating the normal off-bit. These are the pets that only eat Norwegian salmon and lobsters. It is absolutely crazy in terms of what they're eating. But this is where the growth opportunity is. And we also see in the Chinese pet economy, that's where the key growth is, the pet food segment for now.
Oh, we're always told.
Ultra premium market, it seems.
Yeah. Have your protein, always. Right? Ada, thank you so much. Fantastic report there. Our senior analyst there, Bloomberg Intelligence. Very, very quickly, I was told WCRS is your currency ranker. A lot of news, of course, in the macro space today. Everything from South Korea on short selling, the possibility of rate reductions in the Philippines, perhaps more than once this year. And of course, the dollar is, at the moment, down against most in the Asian FX space. Plenty more ahead. That's it from the China show, though. Bloomberg Markets Asia is just ahead. This is Bloomberg.